Hi, everyone. We hope you're having a great first few months of 2023 and getting ready for the warmer weather ahead. To begin the new quarter, we wanted to provide some information relating to the protections and insurance that you have at banks and your brokerage firms. So without further ado, we are going to jump right in to that data. So why are we talking about this? The main reason why we are talking about this is with the recent events of Silicon Valley Bank and Signature Bank failing over the past couple of months, we thought it was prudent to give our clients a reminder of what kind of insurance and protections that they have, again, at both your banks and brokerage firms. So without further ado, how is your cash protected at your major banks? So your cash is typically protected through the Federal Deposit Insurance Corporation, or otherwise known as FDIC insurance. This typically safeguards the funds that you hold in the bank. The FDIC was actually established in 1933 as a result of the Great Depression. This was in response to the widespread bank failures and bank runs that have occurred during that time. FDIC is an independent agency of the U.S. government that protects and reimburses your deposits up to the legal limit of $250,000 per depositor, per insured bank, and per account category. This is something that's very important to know. So that $250,000 is per depositor, so individually, per insured bank. So if you have multiple banks, each one of your accounts at different various banks are insured, and per account category. So if you have an individual account, a joint account, and a revocable trust, each one of those has separate insured limits through the FDIC insurance. Most important to know that FDIC insurance does not cover investment accounts. It does cover majority of deposit accounts, which include your accounts such as checking accounts, savings accounts, money market deposit accounts, and certificates of deposits, or otherwise known as CDs. What's ineligible for FDIC insured coverage is your stocks, bonds, mutual funds, annuities, so on and so forth. How does your FDIC insurance actually work, though? So FDIC insurance is the standard coverage limit of $250,000, again, per depositor, per insured bank, and per account category. The account ownership categories include single or otherwise known as individual accounts, joint accounts, revocable trusts, irrevocable trust, and certain business accounts. You can technically qualify for more than $250,000 in coverage if you hold accounts in more than one account ownership category, as I referenced a moment ago. So let's look at an example here. A couple with a joint account that has FDIC insurance can receive up to $500,000 for that same shared account, $250,000 per account owner. So $500,000 for a couple that has a checking account. In addition, you can also open up individual accounts or single accounts in your Social Security numbers, and that would also cover $250,000 for each individual that's opened. So for example, let's say the couple has $1 million of cash. What is a way for them to protect that $1 million of cash? They would open up a joint account, which they would each get $250,000 of insurance for a total of $500,000. They would also then open up individual accounts in their name only and deposit $250,000 in there. They would then be covered for that total of $1 million. A good way to look at this for a coverage limit is looking at your individual accounts, joint accounts, certain retirement plans. They're each covered up to $250,000 per owner. In the joint account scenario, you're again covered up to $250,000 per co-owner. In revocable trust, you're covered up to $250,000 per unique beneficiary. In corporations and partnerships, you're covered up to $250,000 individually inside of there as well. In irrevocable trust, you're covered up to $250,000 per unique beneficiary that is entitled to that account. So this is a great chart that explains the FDIC insurance limits per account ownership title. Pivoting to look at the summary of the protection of the banks, what you have there, as long as your funds are within the FDIC insured limits, there's really little need to be concerned. Whether that's a regional bank, whether that's a large bank, regional banks, let's say First Midwest Bank here in Illinois, or as a large bank, Chase Bank, for example. As long as your bank is a member of the FDIC, which majority of banks are, there's very little need to worry if you have less than the FDIC insured coverage or less than the FDIC insured limits. So, for example, if you have $200,000 sitting in a savings account or a checking account, that's underneath that $250,000 limit. Again, there's very little need to worry. However, let's say you're holding, as an individual, you have $500,000 sitting in a checking account and you're only covered for $250,000. So that means $250,000 is not covered. What are some ways what are some things that you should consider? First and foremost, maybe open up another account type at that bank. You could open up a joint account or a revocable trust, which provides additional coverage there from FDIC insurance. You can also simply just open up another account at a different bank. So if you were to have, for example, at Bank A, $500,000, but you wanted to make sure that you had cover, or that all of that was insured or FDIC insured, you would simply open up another checking account at Bank B and move $250,000 into that Bank B, and now you're covered for that full $500,000. Additionally, you can buy brokered CDs inside of an investment account. You can also buy treasury bills or treasury money market funds inside of a brokerage account as well. Additionally, these are not treasury bills and treasury money market funds are not covered by the FDIC, but they are backed by the full faith and credit of the U.S. government, which we would say is pretty strong. Lastly, if you are confused about FDIC or if you are covered by FDIC insurance limits, give us a call, or alternatively, you can go to the URL that's listed below. That is the edie.fdic.gov/calculator.html for an interactive calculator that you can simply plug in if this is a joint account, whether this is an individual account, how much money do you have hypothetically in that account, and it'll print out a nice report that states here's how much you are covered, here's how much that is not covered. So that's a great resource if you need it for looking at there. We'll briefly touch on how your funds are protected at major brokerage firms such as TD Ameritrade, Bank of America and Chase. Those are not major brokerage firms. Those are major banks. Major brokerage firms such as Charles Schwab, Fidelity, or TD Ameritrade. There are a lot of protections that are in place at these firms, such as if you are looking inside of your accounts, the brokerage firms cannot commingle funds. So they have to have their own balance sheets for their funds and their balance sheets for the client funds. They cannot commingle those. So you cannot have a brokerage firm that ensures that you cannot have a brokerage firm that commingles the funds, and that is, again, a benefit or a protection for you. The separation ensures that clients' funds are not used to pay for the firm's or brokerage firm's debts or liabilities or expenses. In the event of the firm's insolvency, clients' funds are typically protected and can be returned to them pretty easily. If a brokerage firm was insolvent, that typically SEC or the Securities Exchange Commission will step in and move those assets to a firm that is more solvent, such as if, for example, let's hypothetically say firm A were to go out of business, the SEC would walk in and say, well, that's why we segregate these accounts and why the client's funds will then just be transferred over to another brokerage firm. Secondly, the brokerage firms have tons of insurance in place, and that protects them in the event of fraud, theft, or unauthorized activity. So not because of insolvency, but you are protected that if the brokerage firm were to have some theft, insolvent, or fraud, or any authorized activity in the account, there is insurance in place that would step in and recover those or recoup those funds. Regulatory oversight. This is a large area for brokerage firms. They are required to have regulatory authorities such as the SEC or the Securities Exchange Commission. The Securities Exchange Commission has the authority to investigate and really sanction firms for noncompliance and not having the correct liability, not having the correct balance sheets or commingling funds. Additionally, the brokerage firms themselves pretty much self-regulate. They look at due diligence on the banks that they use or the funds that they use and make sure that they are in compliance. So that's a big thing there as well. And last but not least is SIPC insurance. This really protects the consumer. The SIPC is a federally mandated private nonprofit organization. It was created as part of the Securities Investors Protection Act of 1970, which looked to shield investors from brokerage firms becoming insolvent. Again, this is really the drastic scenario where someone needs to step in or where a firm steps in and says, hey, our firm is insolvent. We need to what kind of insurance protection is there? Again, this is first and foremost, that's why segregated accounts are crucial and why brokerage firms are required to have segregated accounts. If that for some reason was neglected, the SIPC insurance would step in, and that covers up to $500,000 per unique account. So if you have a Roth IRA, traditional IRA, and a brokerage or an individual account, each one of those would have $500,000 protections. That is in the drastic scenario, we would say. Last but not least here is overall, the risk of a brokerage firm failing is rather low, but it is important to understand the protections that are in place if a brokerage firm insolvency were to occur. Last but not least, if you have any questions about anything that we have gone over or anything that has been talked about, if you have questions about the protections that you have or the insurance coverages, please don't hesitate to reach out to us. My email is listed below, but Randy and Anna would be more than happy to chat regarding this as well. Otherwise, we hope you have a great second quarter, and we'll talk to you here soon.